Remgro's profits have plunged. The investment holding company has reported a 40% dive in headline earnings during the 6 months to end December. It says this is due to what it calls an incredibly challenging operating environment. Contributing to that situation has been load shedding, transport and logistics efficiencies, the slow pace of economic and structural reform, and the general erosion of foreign investment confidence in South Africa, all of which have weighed on the group's portfolio of companies, which ranges from healthcare to financial services. An unchanged interim dividend of 80 cents per share has been declared out of income reserves. Brait has successfully placed 15 million ordinary shares in Premier Group. The move has raised 900 million rand. The placing shares constitute about 11.6% of the total Premier shares in issue, and means that Brait's interest in the firm will fall from about 47.1% to 35.4%, and Premier's free float will rise from about 22% to 33.6%. Inflation expectations for the next 2 years have declined. That's according to a survey released by the Bureau for Economic Research. The average inflation forecast for this year has dropped to 5.4%. That's from 5.7% previously, while inflation for 2025 has been projected at 5.3% and at 5.2% in 2026. The survey results form part of the Monetary Policy Committee's debate on interest rates. The next MPC meeting is next week, and while the data will be welcome news for the committee, it may not be enough to tempt it to cut interest rates. Analysts generally expect the MPC to keep interest rates on hold on the 27th of March. The construction sector ended 2023 on a strong note. The Afromat Construction Index expanded and outperformed the economy in the fourth quarter with an annual 3% real growth rate. That's thanks to exceptionally strong performances by the indicators for employment and wholesale sales of construction materials. The research is compiled by economist Roelof Botha, and he says that the year-on-year expansion of the index is encouraging. Looking ahead, Botha believes the sector could expand further given the switch to renewable energy and the likelihood that interest rates will ease. Transnet's tariff discussion document has been met with dread. That's due to its proposed fee structure. The statement is the first step in allowing private operators to access the state logistics company's rail network. But industry players say the pricing model is predatory and will impose longer-term constraints on the South African mining and logistics industry. And this could lead to job losses. In international developments, Nvidia has unveiled a new AI chip. The chip is called B200 Blackwell and is 30 times faster. The tech giant CEO introduced this at the company's inaugural annual developer conference. There's more in this package report.
Nvidia unveiled a new, speedier AI chip that may help it extend its lead in artificial intelligence.
I would like to introduce you to a very big GPU.
Chief Executive Jensen Huang unveiled the chip called the B200 Blackwell at the company's annual developer conference. It takes 2 squares of silicon, each the size of the company's current must-have chip, the H100, and binds them together into a single piece. Nvidia said the B200 is 30 times speedier than its previous chip at tasks like serving up answers from chatbots. But Huang did not give specific details on price or how well it performs when training those chatbots, which has generally been Nvidia's bread and butter. The company also said major customers, including Amazon, Google, Microsoft, and OpenAI, are expected to use the chip for their own AI offerings. Still, the news seemed to fail to provide new fuel for a rally which has seen Nvidia soar to become the 3rd most valuable company in the US over the past year, and Nvidia's stock dipped 1.4% during the keynote. What Nvidia announced Monday will help it decide whether the company can maintain its 80% share of the market for AI chips. Many analysts expect Nvidia's market share to drop several points this year as new products from competitors come to market and Nvidia's largest customers make their own chips.
And Unilever is eyeing major job cuts. That's as the Magnum maker plans to spin off its ice cream unit into a standalone business. Let's listen to this report for more.
Major job cuts and a big divestiture is on the way for the maker of Ben & Jerry's and Magnum. Unilever announced Tuesday it plans to spin off its ice cream unit into a standalone business. The consumer goods giant also revealed a new cost savings program that would cut 7,500 jobs. Unilever said the spin-off will begin immediately and expected to complete by the end of next year. The company said it aims to deliver mid-single-digit underlying sales growth and modest margin improvement after the split. Unilever launched a program expected to deliver total cost savings of around $869 million over the next 3 years. The proposed changes would impact around 7,500 mostly office-based roles globally. Total restructuring costs are now anticipated to be around 1.2% of its turnover during the period. In October, CEO Heinz Schumacher laid out plans to simplify the business as he admitted Unilever had underperformed in recent years. Schumacher had earlier said the company would focus on 30 key brands which account for 70% of its sales. He also aimed to work on improving its gross margin and not undertake any major or transformational acquisitions.
And over in Asia, the Bank of Japan ended 8 years of negative interest rates, raising rates for the first time in 17 years, marking a major change in the country's monetary policy. Let's listen to this report for more.
The central bank ended 8 years of negative interest rates on Tuesday, bringing in a new era of monetary policy in the country. It's the first rate hike in 17 years, but the Bank of Japan is keeping rates around zero, moving cautiously amid the country's fragile economic recovery. Japan is aiming to shift away from a focus on reflating growth with decades of massive monetary stimulus, so the decision was widely expected. Tokyo's central bank is the last in the world to exit negative rates, ending a time where global policymakers used cheap money and unconventional monetary tools to try and prop up growth. The BOJ on Tuesday also scrapped a policy aimed at capping long-term interest rates around zero, known as yield curve control, though the bank said it will keep buying broadly the same amount of government bonds as before and ramp up purchases in case yields rise rapidly. A spike in bond yields would make funding Japan's huge public debt more expensive. The country's public debt is already twice the size of its GDP and the largest among advanced economies. Analysts say Tuesday's announcement will have a very small actual impact on the economy. The central bank is expected to keep monetary conditions loose, and no major hike in household mortgage rates or funding costs are expected. But an end to the world's last remaining provider of cheap funds could jolt global financial markets. After amassing overseas investments in search of yields, Japanese investors may now look to shift money back to their home country.